fools. It is 2 o'clock on the East Coast. That means it's Millionacres. That means I get to talk about my favorite thing, real estate, and I get to do it with one of my favorite people, Matt Frankel. So how are you, Matt?
Good. Hopefully, I'm still one of your favorites. I got rushed out of my house this morning, so I don't have my headset. So you have to deal with me through my laptop microphone.
I won't be too much of a stickler. So today we're going to talk about Vail Mountain Resorts, which I think is kind of the perfect time of year to talk about ski season. They also just had earnings. I believe they hit their highest stock price ever last week or the week before.
They did. They've roughly doubled since the pandemic lows.
Amazing. All right. So before we do that, I'm going to share my screen if I can find out where I'm sharing my screen to. Just a second. Because I want to share just a couple of things before. Can you see my screen?
Yep.
All right. Let me do that. Want to share a couple of things from this month's National Association of Realtors Commercial Real Estate Report, just kind of quickly to just do some interesting scene setting here, because it's been it's a great report. And this year for REITs, Matt, I mean, you're a REITs guy. Well, this is some great stuff here. I mean, the bounce back on retail I expected, but the fact that self-storage is that high is really interesting to me.
Yeah. Well, you were sitting in on the interview yesterday when I talked to Janus International's CFO. They make the prefab buildings for the self-storage industry. So no wonder he said their business is doing so well after I look at this chart.
Right?
It's sectors that you would normally think of as kind of like boring that seem to be leading the charge. Like you said, self-storage. I mean, there are a few properties that are more boring to look at than a self-storage building.
Right.
Apartments are considered like slow and steady rental properties. I mean, retail's kind of, not so much, but the top two are properties most people think of as kind of boring investments.
Oh, absolutely. Yeah, but retail has bounced back. Industrial is not a surprise. Infrastructure is probably not a surprise as well. But interesting to see how this is shaken out. You still see lodging and resorts way down there toward the bottom, right next to office. You see that sort of the last quadrant there is definitely the ones that are still coming out of the pandemic a bit. Office is so weird. But I want to go on to talk a little bit about office. First of all, I want to show this, which is this is building data. This is data from NAR's via CoStar, and you see the trends. What's being built? Multifamily, office is starting to fall. Industrial is just crazy, and retail is also down as well.
Well, industrial is e-commerce. We should
exactly.
at this point I feel like we should call industrial real estate e-commerce real estate.
Yeah.
Because that's really what it's correlated to.
Well, I think that's an interesting thing, because I've been talking to different people about that. It's like, do you call it, because there's industrial, which is the larger umbrella term, but then you've got manufacturing, you've got logistics, and it's really logistics that's kind of moving this. I feel like when we talk about industrial, we are talking about e-commerce, logistics, mobile commerce, all of that, rather than just what we used to think of as industrial.
I mean, you got to figure every time they build a new property for Amazon, it's adding like 5 million square feet to the total. I don't know if you've seen one of those buildings. They're the size of like 7 football fields.
They're huge. Yeah. My mother lives near Port St. Lucie, Florida, and they're going leaps and bounds there. Amazon's going to build, I think it's 100 new industrial facilities. They're trying to get them done before the holidays. Part of that is just the supply chain thing is just messing everyone up. You've got, I don't know the latest total of how many ships there are off the port of Long Beach, but it was over 50 for a while. Nobody can find a shipping container. And so the shipping containers are suddenly very, very valuable because they're all sitting on ships and they can't be unloaded, so they can't be reused. And so part of the ways that companies are trying to solve this industrial problem is that they want to have more places to have stuff near them, just so that they don't have to be waiting on something to arrive from another country and sit there in a port for months.
If you look at the other 3 categories on the chart, I can make a solid case that all of them had a lot of overbuilding going on before the pandemic.
Good point. Yeah.
That's not the case in industrial. I mean, look at where the industrial bars were in like 2019, 2020. They were lower than office and multifamily. in terms of how much percentage you're adding to this total square footage. Office was definitely being a little bit overbuilt, which is why you were starting to see office headwinds before the pandemic. I mean, everyone likes to remind me how Empire State was one of our worst performing stocks before COVID hit. And there was a reason for that. It's because the office market, especially in cities, was facing these oversupply headwinds a little bit before the pandemic. Same with multifamily. I mean, Avalon Bay and Equity Residential, their occupancy rates were not phenomenal before the pandemic.
True.
But industrial supply never overtook demand, which is really what you're seeing play out now. And now with the supply chain issues, like you mentioned, now you're seeing it kind of start to go a little exponential toward the end there.
Well, you and I have talked before about some of the forecasts from JLL and CBRE and some of the other biggies that are forecasting. You know, we need 1 billion square feet by 2025. I mean, there's almost no fear that you can overbuild in industrial right now because the demand is so big.
And with some of them, I mean, not industrial. Industrial is generally a material light type of property. Yeah. They're essentially prefab buildings in most cases. Whereas the supplies you need to build multifamily are in short supply right now, and office, and the labor you need to build those type of properties are in short supply. I'm purposely excluding retail from the discussion because that is a big demand issue. Multifamily, I'm not so sure if it's much of a demand issue because there are a lot of markets that are growing and there is demand. The Sunbelt where I am, there's huge demand for multifamily housing where I am. But there's a labor shortage right now. There's a material shortage. I'm pretty sure the lumber prices have come down to earth. I haven't been to a Home Depot recently, but I'm pretty sure they're not what they were.
They have come down to earth, but steel is really expensive. And so that's been one of the headwinds for industrial is that steel prices are actually pretty high right now.
Right. Well, and I mean, it's a less labor intensive form of real estate. So that helps.
Yeah, definitely. All right. So you just mentioned the Sun Belt. This chart, it just kind of cracked me up. I never thought I would see a map that says top office markets of the third quarter of any year, and that I would see Boise, Omaha, Provo, Daytona Beach. This is just hilarious to me, but it reflects what the impact of migration, remote work, people seeking more affordable housing has really done to the country and the ways that it's remaking it, because people are moving to places, they're working remotely or they're starting companies, and there's not actually enough office space in some of the places that we never really thought we'd need a lot of office space.
Well, one thing to point out just from looking at that chart, a lot of it doesn't surprise me, and I'll tell you why. You remember about 6-7 months ago, all these companies started leaving California.
Oh yeah.
Where did they go? Texas and Florida.
And Boise.
All these,
oddly enough.
And Boise, but a lot of them went to Texas. I want to say a bunch of big tech companies relocated to the Texas markets.
Yeah,
and
Oracle, there was Hewlett Packard. Yeah, there's a lot of movement.
Right, and there was at least one that went to Miami. I'm not sure the name right off the top of my head, but I know at least one went to the Miami area. But the point is, a lot of companies are leaving these higher cost areas. California, it's essentially a tax move. California is an expensive place to have a business. Same with New York and New Jersey and those areas for that matter. And where are they going? They're going to places like Florida, where their employees don't have to pay state income tax. That's a big draw for an employee. At the same in Texas, there's no state income tax on the individual level. It's just more business-friendly markets, easier to attract employees, and a lot of educated people to join the workforce. So I'm not terribly surprised to see those. Myrtle Beach, South Carolina really stands out to me as kind of the head scratcher there, because I've been to Myrtle Beach many times. It's about 2 hours from my house. I'm not sure I've seen an office building there.
But that may be why they need one.
I mean, I'm sure there are. I just don't notice. We go there for the beach. But that's the head scratch for me. Tennessee, I know, is a big growth market as well. A lot of population flowing into Tennessee right now.
Well, one of the things I find kind of fascinating is that the California movement has been different than it used to be. So it used to be you'd get, like Portland, Oregon used to be where people would go up. Now they're going people are moving to Phoenix. Phoenix has had an incredible year. They're moving to some extent to Nevada, but they're also moving to Texas. They're moving south. And then a lot of the Florida activity is coming from the Northeast and particularly from New York. So you've got these sort of, from either coast, people are converging on the South in a way that they didn't used to in the same way.
Well, companies, they not only want lower taxes, that was a big California thing. I know Elon Musk said that he wanted somewhere that had comparable weather to California, which is was a big factor in Texas. You're also seeing people want to spread out. People are valuing their space more than ever before, and that's a big thing in Florida. Florida has a lot of room to spread out when you're coming, especially when you're coming from Manhattan. So you're seeing that as kind of a draw. It's nice weather, lower taxes, more room to spread out. People can become homeowners, whereas in New York, that's not always possible. It's they're nice markets to attract employees, and they're nice markets to run your company in a more economical way. So, like I said, I'm not surprised about those. There are a couple on that map that are kind of have me scratching my head. Those aren't them.
Yeah, that's a good point. All right, so I wanted to share this next. This was a survey from NAR, and the thing that I found interesting about this is when I look at the numbers between 2020, the Q3 of 2020 and Q2 of 2021, this kind of shows me, I mean, this is a survey of commercial real estate agents, but it shows and what they're seeing, and it shows me that there is a bigger return to normal, I think, than is being reported. And I think that we're all spending so much time on what has changed, and we're not necessarily spending as much time on what may not change. So some of the things that I found interesting on this were, the number of respondents that saw headquarters with satellite offices dropped a little bit, working from home and staggered schedules dropped quite a bit. So what I'm wondering is if some of what we've talked about remote work and everything like that, is some of it being overhyped? Are we, and I think the media does this, the media reports the most interesting stories, but doesn't necessarily report what the data tends to show. So I'm interested what you think about this.
If only someone had been saying we weren't all going to be working remotely.
Oh yes, some wise friend of mine.
No, and you're not seeing it fall to zero. Look at the working from home or the staggered office work schedules. That went down 83%. We're seeing it in the third quarter, and now it's 70%. So it's what you're seeing is these trends aren't as to the extent that it was kind of reported. It was kind of being reported that everyone's going to work from home forever and ever and ever. Mm-hmm. And now in 2021, you're really seeing, especially when you look at those two time periods, one had vaccines and one didn't. That's the big thing.
Yes.
The vaccines weren't even a thing in the third quarter of 2020. So you're seeing companies try to return to the office. It's being delayed. Pretty much every big company that announced a return to the office, even the aggressive ones like the banks, have delayed their return to the office. But you're seeing people want to go to work. You're seeing people have like a clear end game is kind of the difference now as opposed to in 2020. Now people say, okay, eventually I want to be able to go to the office. Not going to happen right now, but eventually I want to. Whereas it was a lot more uncertain, I think is really the word. It was a lot more uncertain in 2020, and now it's okay. We're going to be able to get back to normal life at some point. It's kind of the way I feel like people think about it now.
Yeah, I think that's true. And I think that's kind of a nice segue into talking about Vail Resorts, because they're kind of hoping this remote work thing lasts a little longer just so that people keep skiing. And I think one of the things that is interesting when you look at, this is a map of where they have all of their resorts. And one of the things that they talk about a lot in their earnings and their investor presentations is how they've got that nice Northeast cluster and how so many people can reach all of those resorts within driving distance, which I think has been pretty good for them as we sort of reset, and they're looking forward this year to having what seems to be an almost normal year. Last year, not quite a normal year. This year, it seems like they're still expecting maybe some of the ancillary businesses will be a little bit slower, but mostly in the US, they feel like they're getting pretty close to having a normal ski season.
Yeah, those drivable properties were really the key.
Yes.
I mean, air travel, I mean, it's happening now more than it was, but it's still not ideal. Planes are being canceled a lot. There's a big labor shortage in the airlines. It can be tough to, go. I mean, I'm on the East Coast. It's tough for me to go to Colorado, even if I wanted to. Not to mention, I don't really have a reason to right now because there's no office things happening over there. But it's the drivability to attract. You're seeing a big difference in companies that have drivable assets versus companies that are just kind of tourism, like long distance tourism dependent.
Mm-hmm.
I feel like this is Ryman Hospitality is another company we talk about with this a lot. Their destination, their business got hit very hard in 2020 because they generally rely on people traveling long distances to get to those 5 properties. People fly a long way to go to Gaylord Opryland, for example. People fly out. They have a property next to Vail Mountain, Gaylord Rockies. So they rely on people kind of flying long distances. Companies like Vail that have they have the fly to properties, but they also have a lot that's in driving distance, like those Northeast properties, which really kind of their saving grace right now.
Yeah.
That people in New York City who just need some air can just get in their car and go to. And same in California, they have those California properties. Some of their international properties haven't been doing so great, but the business hasn't really rebounded to where it was before the pandemic. But it's a lot closer than you would think, and those drivable properties are a big reason.
Yeah, absolutely. And yeah, the ones that have struggled a little bit, Australia, I mean, their ski season is sort of the opposite of ours, and really been struggling with, Australia's been very strict in certain areas with lockdowns. That's impacted them. The other place that really saw a lot of impact that they've talked a lot about is their Whistler resort. And part of that is a lot of that Whistler traffic comes from Japan and China, and some of that just isn't coming right now. Not necessarily a long-term concern. The other concern I think about the Whistler Blackcomb property that they talked about is conferences. And so, which, speaking of Ryman, that was, their business too, is that they had to pivot from conference to leisure travel. The properties that Vail has that are like really good day trips, things like that, are doing much, much better than ones where they're looking at conference activity and things like that, at least for right now.
Yeah, and I know we're going to get into the discussion about how the economics of the passes that they use on one of these next slides. But that's really been they've really used the passes as a way to get local business in there. I mean, Disney World had the strategy down for a long time, getting the local business in there because, you don't make any more money from admission, but you get a lot more money when they go to restaurants and things like that.
Oops. I'm going to stop sharing for 1 second since my slides just went a little crazy.
That's okay. I couldn't see what else was on my screen too, so now I get to see it. No, the annual passes and the local passes especially have really been a nice little pivot on their part. I'm pretty bullish on the return to the office. As far as the return to conferences, that might take a little bit longer. I'm not as bullish on that as I once was. I'm still pretty bullish on the office return. Maybe it's because the conference I was going to go to in November just got moved virtual.
Oh, really?
Yeah, I was going to go to REIT World.
Oh, yes.
And that just got moved virtual. Supposedly CES in January is still in person. And if that happens, I might change my tune on conferences. But for the time being, I'm not that optimistic.
Well, let's dive into talking about the passes thing, because this is really interesting to me in understanding Vail's fundamentals. And this is sort of, and it's an industry-wide shift from this idea of, like, when I was growing up, you'd go to the ski slope, you'd get that little paper tickety thing that they'd clip on your parka, and off you'd go for the day. Now, for Vail especially, they're doing this massive shift toward passes. And it makes sense because it's reliable revenue, obviously, brand loyalty, awesomeness, but it's also more days skied and more of that ancillary revenue. So, food and beverage, ski rentals, ski school, things like that. And so it seems to me like what they've talked about too is that Vail, they're really trying to push to passes. And one of the ways they're doing that is by kind of changing up the flexibility of the pass. So I think when passes first rolled out, there was like one pass and you'd pay one sum and it got you access to everything. And there you go. Now they've been kind of fine tuning and filtering that so you can get passes depending on your area or depending on, weekdays versus weekends or certain things like that make it more attractive for people.
Yeah, their Epic Day Pass is one that's really interesting. That one you can pick, you get to choose between 1 and 7 days, and it gives you access to all of their resorts. So if you want, 7 days of skiing during the season at, assorted Vail Resorts, that's a way to get it. It's not just the season-long passes now. And the economics of the passes, even if it sounds like they're getting less revenue, which my wife and I we're Disney annual pass holders. The cost of my pass is roughly 7 days of admission. That's what I pay for the entire year. So if I go 20 days, it might sound like I'm getting 13 days for free, but that's 13 days that I'm going that I otherwise wouldn't, that I'm spending money at the restaurants, at, buying my kids a new stuffed animal that they want, things like, and the same thing applies here. They're not getting any extra admission, but there's more people renting skis, taking lessons, spending money at the restaurants, using the hotels. One really kind of genius thing about their annual pass is it gives the holders 20% off lodging and rentals and things like, it encourages them to spend money every time they go. And it's a strategy that's really starting to work out. As you can see in the chart in front of you, that revenue mix, I want to say in 2021 so far, it's even more than 40%, 47% pass revenue.
Yeah, it's really interesting. And you're right. It really does come down to all of those other things that you do when you're there. And it also comes down to this idea that there is that stickiness. There is that brand loyalty that if you're a pass holder and you tell your friends you're a pass holder, let's go ski here. It's very, very, it's sticky. People look forward to getting the passes every year. And I think that's an important part of it too. And so this chart shows more about that past revenue, and you can see how they've slowly done it over time. You've got that little bit of that sort of dotted area right there is from because they had to refund they had to give discounts on some of the Epic Day passes because of the pandemic, but they keep launching different types of passes, and they're just seeing that strong number. It's great to see that kind of revenue as they keep going.
Yeah, you can see under fiscal year 2020 where they launched the Epic Day Pass that I was mentioning.
Yes,
you could. For the revenue to barely be down in 2020. Obviously they had to refund a bunch of passes, but revenue really wasn't down that much. And those day passes had a lot to do with it. And if you look under fiscal year 2021, where they launched their Epic Mountain Rewards, that's the program where the pass holders get 20% off all those adjacent things. That's really kind of, boosted revenue. So it makes the pass itself more valuable because, one of our favorite perks of our Disney passes is we get discounts on certain things in the park. We get free parking, for example. So it makes the pass itself more valuable, and it encourages people to spend more money every time they go there. So it's really kind of a 2-for-1 in terms of revenue growth. And I'd be very surprised if the pass revenue wasn't significantly higher in 2022, assuming the world achieves a more level of normalcy than it is right now.
Well, and the other thing that you mentioned too, like with your Disney passes, is it becomes a family thing. It becomes a tradition that, your kids expect that you're going to have the pass, that you're going to go to Disney. And the same thing happens with skiing. Ski families tend to be ski families. They tend to go year after year. The kids expect it. And so it's hard to once it kind of got you into this system, it's so sticky. It's very hard to tell your kids, no, we're not going to go skiing this year. What?
I'm not a big skier, but I can tell you that very few businesses have the kind of pricing power that Disney does. And I'd imagine it's similar economics because, like you said, you renew them every year. If you go skiing every year, 5 or 6 days out of the year, your kids are gonna want to do that every year. So it's a very sticky type of revenue. It gives them a lot of pricing power, and they can raise the prices of those passes faster than inflation, which is a pretty nice recipe for growth over time.
Well, that's why I kind of like this chart, which is from their investor presentation earlier this year, and talking about that value over time is you get that, you get the renewal rate because they're more likely to renew as time goes on. They're more likely to keep spending money, and all of that really adds up to lifetime customer value, which is really, really important to Vail. Is that they're trying to get new skiers, of course, and introduce more people to skiing and snowboarding, but a lot of their revenue and a lot of their success comes down to getting the most value out of not having to get a new customer, but just kind of keeping that same customer year over year.
Yeah, I mean, I'm actually surprised the renewal rates there aren't more. I think this is a kind of conservative estimate. If you look, they're expecting 50% renewal in year two. I think I think it would be a lot more than that. Like you said, people expect to do the same things every year. Unless the prices go up significantly, I really don't see renewals being that low. So I mean, the value, I think that's a very conservative estimate of lifetime value is kind of what I mean by that.
Yeah, that makes sense. All right, I'm going to stop sharing for a second and let's go over some of the earnings because they had a strong quarter.
Yeah. So hold on. Where'd the thing go? I totally lost like my whole screen right there. But no, the earnings. There we go. The earnings look pretty good year over year. Just to kind of put things in perspective, it's not back to where it was pre-pandemic yet.
Right.
A lot of real estate businesses we talk about are back to their pre-pandemic revenue essentially, especially ones that rely on rental income. That's not really the case here. Just to kind of throw some numbers, in fiscal year 2019, which was the last full fiscal year before the pandemic, net income was just over $300 million. In fiscal 2021, it was $128 million. So net income's down significantly. EBITDA is down about 20% from pre-pandemic levels, and it's just kind of expected to get back a little bit over pre-pandemic levels in 2022. So the things that I was most encouraged about from their earnings is how much they're investing in their properties. One,
yes,
because that's one of the big things they pumped the brakes on when COVID really started. And it just kind of shows confidence, number one, that they're able to spend that money, which I don't know why they would be. They're a very cash-rich business, by the way. Vail has $1.2 billion in cash on the balance sheet right now and another $600 million or so of borrowing capacity. So I'm not surprised they're comfortable spending that much, but that is the most capital spending they're doing in a single year to date. And kind of the idea is to add value to their properties to make those passes valuable. At the end of the day, it's all about the passes. You're trying to improve the customer experience. I know a big thing they're focusing on are the lifts, which like I said, I'm not a big skier, but Matt Argersinger says that the lifts are kind of the biggest consumer pain point at ski resorts in a lot of cases. And they're trying to really work that out and have the best in the industry. And the term best in the industry really has described Vail's properties for the most part. So they're really doubling down on creating the best customer experience and maintaining the best customer experience. And that should translate into revenue. But out of their earnings, like I said, they're not quite back to pre-pandemic levels. But the fact that they're willing to spend that much money on their properties and really improve their operations right now, when a lot of their competitors are not doing that, was probably the most encouraging part to me.
Yeah, I'd agree with that. I mean, the capital plans for 2022, they're gonna it's 350 million to 325, which is around 150 million above, which is pretty amazing. And so they're expanding in Beaver Creek. They're putting new lifts in at Breckenridge. They're doing some upgrades at Akimo. Basically, they're doing 19 newer replacement lifts at 14 resorts. So Matt Argersinger's pain point there is definitely going to be shifting at some of these resorts.
Well, my whole point when I brought Vail onto our attention on the Millionacres team was that this is a business that's naturally conducive to social distancing, and Matt quickly stopped me and said, "Except at the lifts, except at the lifts where all the crowds build up." So it could also be a play, a social distancing play too, to have better and more efficient lifts, get more people in the door, even if social distancing has to last another year or two.
True. And so another thing for earnings is the dividend is back, right?
Yeah, about half, right?
Yeah. Yeah. It's cash dividend of 88 cents a share starting in October. So that's 50% of pre-pandemic levels.
Yeah, I mean, that just like the spending, it just conveys confidence, really. That's a big, I mean, you saw the stock pop after earnings a little bit.
Yes.
It just hit a record high. And a lot of that is because of the confidence the company is conveying. It's not necessarily because of the results in this past quarter, which were okay, but the confidence in bringing the dividend back when a lot of people didn't think they were going to, the spending caught a lot of people by surprise. And the dividend, it's not what it was, but they're saying, okay, we feel confident spending this money and giving money back to shareholders, and we are going to be an income stock in the future. So that it's a confidence boost.
Well, they also announced that they're exiting the temporary waiver period under the Vail Holdings credit agreement. So that's also another sign that they're feeling more confident too, right?
Yeah, I think that was one of the conditions of the waiver agreement is that they couldn't pay a dividend. We saw something similar with EPR, which is actually one of their landlords.
Right.
Remember, EPR owns a lot of their properties, and they just started paying a dividend again because they waived their credit, the credit modification agreement or whatever it's called. So that's a big step in the right direction. Even though the business isn't back to where it was, they're saying it's going to get there sooner rather than later.
Well, and they issued guidance, which is also a sign that they're feeling more confident about what may happen, that there's less of an uncertainty. So their guidance is net income between 278 and 349 million for fiscal 2022. They believe that the resort reported EBITDA for fiscal 2022 will be between 785 million and 835 million.
That's actually a big bump from pre-pandemic levels.
Nice. I mean, they're still looking, I feel like they're still saying that the recovery at Whistler is going to be slower. That's something that they're looking at. But overall, they feel pretty strong. I mean, they're still reporting or forecasting a first quarter net loss in 2022 of between 156 and 136 million.
Yeah, I don't pay that much attention to their bottom line numbers. They have a lot of real estate operations, so it can kind of dilute net income a little bit. One of their biggest, they operate in 3 business segments, and one of them is real estate development. So that one has a lot of depreciation and things like that attached to it.
Right, and they're not a REIT.
Right, and they're not a REIT, so they don't report FFO. But it does still have the same effect of distorting net income when you own that much real estate like they do.
Yeah. Well, let's talk about some of the things that make us excited about Vail. I think for me, it's one of the things that they talk about that I find really interesting is the past economics and all of that data. I feel like they're getting smarter and smarter about every single customer. The past allows them to really, really hone in on who spends what, where they do it, how to get them to spend more. I think that's one of the things that I think that they're being so smart about is you're taking this sort of experience that's not traditionally data heavy, and then you layer data on it, you get so much smarter. Part of what they're doing with using that data is they're learning what they can centralize and what they can integrate so that they reduce their costs over time. And I think that's a really interesting and smart move as well.
Yeah, and with the passes, another key point you have to remember, it's not just about increasing revenue. That's definitely part of it, getting people to spend more at restaurants and things like that. With passes, it's recurring revenue and predictability.
Yes.
Which, as you just mentioned with the data, it's not just about the pass prices and the renewals and things like that. It's being able to predict how much restaurant revenue you're going to get by lowering your pass price or something to that effect. If I give a 20% discount on restaurant revenue, how much is that going to translate into predictable recurring income? So recurring income is very, very valuable, especially through a real estate type company. But I mean, I would take $1 billion of predictable revenue over 1.2 that could go like this, year after year. So I mean, it creates recurring revenue, which is kind of the whole investment thesis behind the software as a service businesses everyone loves so much. It's recurring revenue subscription model, and it really transforms the dynamics of their economics.
Absolutely. And talking about those capital expenditures, more lifts means more capacity. They're really able to use, because they can see that revenue, they can see that it's going to come. There is that predictability of renewal. You can spend that money and think, okay, well, I'm going to increase capacity in these areas because we've seen more traffic there and things like that. So all of that leads to smarter deployment of capital. And I think the other thing that's really fascinating to me is the way that they talked about relationship with other countries, specifically with China and Japan, and that connection with Whistler, and also their existing partnerships with 2 resorts in Japan. So it's clear that they're looking, they're happy with their US business, but they're also looking to continue to expand beyond what they've already got going on in Australia and in Canada.
Yeah, speaking of international, this is kind of related but not. Starting in November, you're going to see European tourists being able to really come back to the U.S. in large numbers. They released a lot of those restrictions, and that's a lot of Vail's business that has been lost due to the pandemic. It's not just that people can't fly across the country; it's that a lot of their business is European in nature, and you're going to see that really start to come back in the winter months, which I think was another reason you saw the stock get a big boost. It's because international travel is coming back. I know that's great for Florida tourism too, being a Disney guy, but it's really good for the skiing industry. I mean, I don't know the exact numbers, but I know it's the European clientele especially is a big part of Vail Mountain's typical customer base.
Absolutely, yeah. Let's talk about some of the challenges. I think one of the biggest ones is one of the challenges that's affecting hospitality as a whole, and that's wages, being able to hire people. The other issue that you have sort of together with that, me, I'm a housing nerd. Housing in ski areas has been a concern for so long. It's so hard to find places, especially Vail, Aspen, places like that. There's just not enough housing. I think it was in Aspen that they were trying to do tiny houses for people for the season. It's a huge issue, and it's something that Vail has talked about a bit.
Yeah, it's a big problem that needs to be solved. And I don't know the correct answer to it. I would like to see them start to build some employee housing. I'd be surprised if they don't have some already. But that's usually an answer in high cost areas. I know I used to live in Key West, Florida, where it's very expensive to live. And that was a lot of the hotels they found workers by offering them workforce housing. Like they would convert like an older wing of the hotel into essentially dorms, and house people for free. So I don't know what the answer is, but it's definitely a problem, and it's getting worse. In the past year or so, it's gotten a lot worse. I don't know if you know off the top of your head how much home prices have increased in Colorado, but it's been one of the better performing markets of the year. So it's not only a problem, but it's becoming worse over time.
Well, that part of that too is the resort markets were disproportionately had price increases last year, both in rentals and in home sales, because remote work. Everybody was like, "Hey, I want to go there. Well, why not?" So that was a concern. It's starting to slow down, but it's still a concern. So one of the other things that is an ongoing concern is that Vail has announced that there are vaccination requirements, and they are going to require masks indoors around food and beverage and things like that at the resorts. So shouldn't be a huge drag, because most of the time people are outdoors, they're skiing and snowboarding and enjoying the mountains. So you've got that, but there still is going to be that masking indoors. It could drag down some of the food and beverage. And that's one thing that may be a short-term concern.
Yeah, no, and they said that COVID is going to have an effect on the business for the foreseeable future.
Yeah.
What that means, we don't know. I don't want to get into weeds on the vaccination requirements and things like that. But I really don't see it being that much of an issue for Vail's business. I mentioned European travelers. They have to show vaccine cards to get on the airplane to come here. So I really don't think it would be that much of an issue for international tourists who want to go to Vail's properties. And I mean, it's going to cost them some business, but whether it's really going to affect their business, I'm not sure. The masks might hurt the restaurants. I think that's the top concern. I don't think the vaccines are the top concern when it comes to the business wise. Masks might have something to do with it. I know I find it less convenient to go to a restaurant, especially with my little kids. And not necessarily for me. I don't mind putting a mask on. My 3-year-old does. So I can see that being an issue, especially with families. You know, they might say, okay, we'll eat in our room. But it's going to be an effect, and it really remains to be seen how long. I, I've heard 500 different predictions on when the pandemic's going to end and taper down and things like that. And they've all been wrong. Some have come from me, some have come from other people. We've all been wrong. So I don't want to pretend to have a crystal ball where to kind of tell you what the effects are going to be, long term. But it's definitely going to have some effect and keep the business at somewhat below a normal level this ski season. I think I can definitively say.
I would agree with that. The other challenge that is still kind of a wild card is that Calder fire in the Lake Tahoe area. It has started to affect some of the resorts. They still haven't put that thing out. It's far too soon to know exactly how much that's going to really impact things. But that's one more challenge that they're dealing with.
Yeah, are those the big resorts that Vail owns out there? That one's impacting.
Yeah, it's around Tahoe. I think it is. I think it is one of the bigger resorts. I'm not entirely certain.
And I can just one statistic that I wanted to mention before I forget. Vail owns roughly 2% of North America's ski resorts. They get 17% of North America's ski visitors. That's how popular their properties are. So I don't know those particular properties, how much of their business comes from there. I know their business is top heavy, meaning that a few resorts are wildly popular and account for a lot of their business. But the fires out there, it's a concern. I mean, it's something to keep an eye on. I don't think it's going to have a devastating impact on this ski season, but it's definitely something to keep a lookout on.
Absolutely. And so, yeah, you mentioned that the top that they acquire top resorts, right? So the question I think now too, that's really exciting to think about is where are they going to go next? Because one of the things that as you sort of track the ski industry, I feel like I say this about every industry, but the individual resorts, there is a landlord aging factor even in resorts. I mean, biggest example might be Robert Redford, selling off so much of Sundance and things like that. There is that natural transition that's going to happen. I think that Vail may be in a position, solid balance sheet, ability to acquire great credit, that they may look to add some more things. And sort of one of the things I think they understand is that they need to flesh out their western side a little bit, because they're really strong in the Northeast, but I think there's some opportunities for them on the West.
Yeah, I would say drivability is the key. They want to target in driving distance of Seattle, for example. You mentioned the West. That could be something that someone that lives there could easily drive to. Drivability is a really big factor right now. They have the destination resorts. I don't really see them adding to their Colorado portfolio that much right now. I don't see that being the big focus. I think the focus is going to be these kind of regional resorts. And like you said, they can stand to build out their Western portfolio a little bit. I don't know. What do you think about international expansion? Do you think they're going to focus on that, or do you think that the pandemic has kind of scared them away from that for the time being?
I don't think so, because they sounded so bullish about Japan and about China. I think they feel that the next big wave of skiers is going to come from China and Japan. So I think I wouldn't be surprised to see them actually try that. I mean, I know the Australia acquisitions haven't quite worked out for them yet, but I feel like that's so much more of a pandemic problem than an operational problem.
Oh, for sure. I mean, who wants to get on a plane and have to wear a mask for a day and a half or however long it takes to get to Australia from here to go there? But I could see them kind of maybe doing something in Europe at some point. There's I mean, people ski in Europe. I mentioned that's where a lot of Vail's.
Oh yeah.
That's a lot of where their American clientele comes from. They fly from Europe. So I could see them eventually branching out there. I think that could be an interesting growth area for them. But I think the regional resorts are really where they're going to try to find the most growth.
Yeah, I think that's true. Well, let's talk about the leadership shift, because that's a big thing for Vail, is that their CEO, they've had the same CEO since 2006. Rob Katz, he joined the board in 1996. Their new CEO is Kirsten Lynch, who is their former CMO. She joined the company in 2011. She was formerly at PepsiCo and Kraft Foods. She's on the board at Stitch Fix. She's a longtime skier. I think she grew up outside of Chicago. She's now based in Boulder. And so the company is making that transition, I believe, at the start of November. So it's a big shift. He's been there a long time, but he's definitely putting in someone who's also been there a long time. So it shouldn't be a huge transition.
Yeah, he's actually been there longer. He joined the company in 91.
Oh, really? Wow.
And he's leaving some big shoes to fill.
Yeah.
I don't know if you looked at their performance stats in his tenure since he became CEO in February 2006. 1,270% total return, 1,270. That's about 19% annualized returns for shareholders in his 15-year tenure. That's pretty big shoes to fill.
Yeah.
And one of my big parts of my investment thesis is he's heavily invested. He owns almost 2% of the company. It's not a REIT, so you see a lot of insiders owning a little more of the company. With a REIT, that's not as practical all the time. But he owns almost 2% of the company and has delivered. I mean, he's made himself a very rich man and his shareholders over the years. So I like the hire. I love when they hire from within, especially someone who the CEO has worked with and kind of put like room for the position, I guess you'd say.
Yeah.
So I like that, but he's leaving some big shoes to fill.
Well, and he's not leaving the board or anything. He's sticking around. I'm assuming at least for a while.
I'll tell you, if she produces 12x returns in the next 15 years, I think everyone will like her just as much.
Well, of course, we all love a winner. All right. So one last thing I want to talk about with Vail is they just announced this at the same time that they, right after earnings, was they announced they've got a deal with Toyota, which I think is, branded deals are branded deals, whatever. But I think it's kind of interesting because they're actually part of the partnership is that they've got these, they've got the Toyota Race Center at Beaver Creek. They've got they're putting in terrain park features at Park City, Mount Snow. They're putting in bike park features at Crested Butte and North Star. They're bringing in courtesy vehicles. So it's a little bit of a branding play, but it also seems to be a pretty heavy one. I mean, they're doing the whole mountain operations team is getting those Toyota 4-wheel drive vehicles. So it's a pretty big partnership.
Yeah, I mean, anything that adds value to their properties is definitely good. And if it's a branding play, then so be it. But I mean, it reminds me of the GM Disney partnership. I keep mentioning Disney, but it's got a lot of parallels to Vail.
Absolutely, yeah.
I mean, they partnered with GM to develop the Test Track ride at Disney World, and that's the Test Track by GM. Mm-hmm. And it's been a big hit for both companies. It gives GM a way to show off their new products. When we get off the ride now, there's one of the new Corvettes sitting there, for example. So it's a win-win situation for both. It leverages the expertise of Toyota. I think they're doing courtesy vehicles and things like that for Vail as well. So it leverages their expertise, it enhances the customer experience, and it exposes more people to Toyota's products. So things like that can be a win-win. I don't think it's going to be a massive needle mover. It's just kind of an incremental value add to their properties.
Yeah, I would agree with that. We've got a question from Brendan who says, I live close to Whistler and I know Whistler is a popular summer destination for hiking, mountain biking, lake activities. Is Vail able to monetize summers in its resort without selling ski passes? I know that they do have things going on during the summer, but I'm not sure if I don't think they don't put passes or anything to it like that. It doesn't seem like they see it as a huge part of their business.
Well, I know our last writers conference with the Ascent was at Vail Mountain during the off season.
Oh, was it? Well, how was that like?
It was nice. There was no snow, but there were things to do. There was still a lot going on in town. And I think there was a craft beer festival going on while we were there. They find ways to monetize. I don't know off the top of my head if any of Vail's properties have year-round snow. I know there are very few in the U.S. that do. But I know that they still do monetize. I mean, Vail Resort, there were no shortage of people there. I can tell you that much. And we were there in the off season. So they do monetize its resorts during the summer in different, like food and beverage is a big one. We had, I mean, in a 2-day conference, we ate at 3 different restaurants on Vail Mountain. So I mean, they do monetize in those kind of ways.
Yeah. Yeah. I think there's just, and some resorts I know will put in like little rides and things like that that sort of make it more, more fun to go up there for the kids and things like that. So but it doesn't, from what I've seen in terms of their revenue, it's not something that they focus on as much. It really, most of the revenue comes from ski season.
And I know that the mountain pass or whatever it was, the rewards that I mentioned, the 20% discount in a lot of places, it's good during the summer season. So they entice people with 20% off their hotel room and 20% off food if you're a pass holder. So the pass holders still go there, to get a nice discount on a good meal and things like that, even if it's not ski season.
That's an interesting point too, is that may end up being something that becomes more important as time goes on for the value of those passes. I think that could be something that does become interesting if you know that you can go there during the summer and you can get that discount. Maybe you go there versus going somewhere else. I mean, I love, that's why one of the reasons I just love this is that idea of that customer stickiness, customer loyalty. They feel like they want to go there. They go there in the winter all the time. It's like, oh, we should go in the summer and see what it's like. And all of that kind of feeds on itself.
One thing I can say about Vail is it has 37 resorts, right? There are 290 retail and rental locations. So retail stores, things like that. There are 215 dining venues throughout its 37 resorts. So that gives it a lot of room to monetize without skiing. You bring in little conference groups like ours was and things like that. And it gives you kind of a nice revenue stream that doesn't depend on your core business. Because not everyone skis. I don't ski, but I like to eat. So.
All right, let's go through some of the questions. Lisa mentions that she's going to a conference in Houston next week. That's definitely still seeing conferences here in DC this week. There was the National Association of Business Economists. They had just had their conference, half in person, half, half. They're doing a hybrid, which I think so many conferences are doing right now.
I was disappointed that NAREIT went totally virtual for their November conference. I get it. But there are, I mean, the week before that I normally go to is Money 2020, and they're still having their conference in the same venue a week before. So I don't know why NAREIT decided to pull the plug on it, but it was disappointing. I haven't been to one of those in like 4 years.
Well, I believe it's the National Association of Realtors is doing theirs live in San Diego. I believe that is at the start of November usually. So, I think it's interesting because it's just such a company specific decision, and so much of the decision making is speculative. And so depending on how comfortable someone in charge feels about it, that's kind of is how it goes. It seems a little less fact-based and a little more intuitive than I would say than earlier in the pandemic.
Yeah, I'd say that's fair. And a lot of it's like you said, it depends on who's putting on the conference. NAREIT's based in New York, I know, and a lot of the REITs that are represented are based in New York. And there aren't really a lot of big meetings happening in New York yet. And a lot of, offices are still closed there in contrast to other places in the country. So that might have played into the decision somewhat. I know CES is a more, California-based play. So that, the attitude just seems to be a little bit different when it comes to who's putting on the show.
Yeah, but New York is. I was in New York City this weekend. New York is back-ish in terms of tourism, in terms of people on the street. Yeah, Times Square seems to be relatively busy. It's coming back.
Not in terms of going to the office.
Not in terms of going to the office. I think we're still around under a third of people are back in the office in New York City.
I mean, I'm in an office right now. That's not a thing in New York.
Not a thing in New York. Not quite a thing in San Francisco, but most other places, much more of a thing. So I wanted to read this comment from Dwight Schrute, who says, although there are big businesses leaving California, the number of startups here is 2 times that of Texas and Florida. Part of that may be California's attraction for new immigrants to the U.S. I wish more companies would leave so our housing prices can come down, but I think the whole Leave California movement is overblown. Yeah, housing prices. The housing prices in California are just out of control. I mean, we've got a median price that is really, really just really unsustainable. You started to see rents go down in San Francisco during the pandemic. That did not last that long, but he does make a good point. I recently interviewed the CEO of Urban Catalyst. It's an opportunity zone fund that they are building in San Jose, and they're still seeing so much startup activity. And so there is still that idea that if you want to build a tech company, you want to build a startup, you have to go to Silicon Valley, you have to go to Sand Hill Road, you have to do that. That's where the money is. There is still that. It's shifting. I think it's more easy to get money remotely. You don't necessarily have to be there anymore, but it does. It's a work in progress, I think.
Well, that gives me a good question to ask when I interview Howard Hughes' CEO tomorrow, because their biggest market is Texas.
Yes.
And I'm going to see, how it's helped, because they have a lot of office properties. I know Occidental Petroleum is one of their big tenants. They have a lot of office buildings in the woodlands. That's their community. So I'll ask him and see what the company migration trends are.
And
when it comes
that's in
to
Houston,
Texas.
Right?
Yeah, they're in Houston.
Yeah. Yeah. Houston is an interesting one for me because you would think that oil and all of that is a shifting economy, but I'm also hearing about lots of companies moving to Houston too. So I'm not completely convinced it's a one industry town.
Yeah, I'll have to ask, just because they're in some markets that are kind of like lower cost but nice weather, like I would call them. Like Houston, like Las Vegas is their second biggest one. They have the Summerlin neighborhood near Las Vegas, and they have the seaport in New York, so they can comment a lot on those kind of trends that seeing people go from one place to another.
Well, that actually makes me want to ask you something, which is about that cosmopolitan deal with Blackstone. So you mentioned Las Vegas. One of the things that you and I have seen is Las Vegas tourism has been back. Everybody seems to feel just fine with going to Vegas. Conferences, you mentioned CES. Maybe we'll get that one back. But there's been some activity on the Vegas Strip lately in terms of buying and selling.
Well, yeah, the owners of the Cosmopolitan is Blackstone. They bought it out as a distressed property a while ago when it was still being developed, and they've announced they were trying to sell it. It's one of the few independent casinos on the Strip. Pretty much everything on the Strip is operated by one of three companies: MGM Resorts, Caesars Entertainment, or Sands Las Vegas, or Las Vegas Sands, which is the Venetian Palazzo, and then there's Wynn Resorts, a few further down the Strip. But Cosmopolitan was right in the middle of a bunch of MGM and Caesars properties. So it didn't make sense for Caesars or MGM to acquire the building. That's a very asset-heavy purchase. It's one of the most valuable properties, if not the most valuable, on the Strip. Blackstone wanted over $5 billion for it. That wasn't going to happen. But quite frankly, it's not worth that right now. They ended up selling the building. They announced afterwards they're selling the building for $4 billion to an investment group, partially composed of Blackstone itself. And they're selling the business operations to MGM, which makes sense because MGM's two most valuable properties in Las Vegas right now are the Bellagio, where the big fountains are and things like that, and the Aria. Right in the middle of those two is the Cosmopolitan. So now they have the three in a row, and it kind of gives them dominance over that little area of the Strip. So it definitely makes sense as a strategic acquisition. Cosmopolitan is specifically designed for the younger crowd. I feel like the old guy when I go into the Cosmopolitan. That's not the case at a lot of other places in Vegas, where I still feel very, very young at a lot of places. But in the Cosmopolitan, I feel like the old guy because it's a millennial-oriented hotel, very much so. I'd say the 25 to 30 crowd is really the sweet spot for that place right now. And it kind of brings that demographic into the MGM ecosystem, where that's an area they were severely lacking. Their nice property, I mentioned the Bellagio and the Aria, are built for, the 40 and older crowd. They're very nice, but they're built for the older crowd. So, which is probably why I feel so comfortable at those places. But this kind of brings a whole new demographic into them. And if that happens, if it brings that new demographic into MGM's ecosystem, then it could be a price well paid.
Well, and of course, because you've got loyalty programs and everything else that's been along from that, which kind of brings us back to, as we wrap up, just talking about Vegas. Isn't that dissimilar from talking about ski resorts? Because you're all it's the same economics of getting people to return, monetizing them through, the other things that they spend money on, and building that brand loyalty, which is really what it's all about.